Hi, welcome to your market update as a member of the candlecharts.com family. Now, if you remember, I did a market update back in March, and we're looking at the S&P, and at that time, and that's the red arrow, when the market broke above this resistance area in March when the S&P was trading about 1550, 1600, my upside target was 2200. That is still my target, but I just want to give you a little bit more of an update on it from a risk-reward perspective. First of all, as long as I have this chart up, well, one of the things we had discussed when the market broke out, and I'll show you how I got that price target of 2200 in a minute or two, but one of the things that I'll always do for my investments, my longer-term investments, or trading, when looking at a chart like this, when the market breaks above a major resistance area, based on, if you're familiar with my change of polarity, a multi-tested support area once broken becomes resistance, and on the flip side, a multi-tested resistance area, if the market is solid, should become support. So let's go back to this chart over here, and so notice how the market closed above the resistance area, and it may be a little hard to see, but notice we had a little bit of a correction after March, and notice how that correction held this old resistance. So that worked out really well. That old resistance became support. So my scenario, my longer term bullishness was still intact. Now, how did I get the 2200? What I was looking at is essentially the market was in a multi-year trading range, and I took the height of the trading range, and I was conservative because actually, the bottom end of the range could be here or here, so I'm doing it from here. So essentially from about 1500 to about 800, so that's 700, you add 700 to the breakout of 1500. This is a very typical Western technical analysis technique of getting a measured target, a price target. It's actually one of my favorite, measuring a box range. So you add 700 to 1500 and you get an upside target to 2200. So as I mentioned before, that is still my scenario. However, it's interesting when I get together with people and tell them what I do, and I ask my market outlook, and I tell them that I'm still bullish. I do caution them, and that's why I wanted to do this short session, that yes, my target is 2200, but my support area is still the same. The major support is down around 1500 to 1450, give or take. So if you're buying it here around 1800, 1750, I would still be bullish unless the market got under, let's say, 1500. So from a risk-reward, doing something here I don't think is a good scenario from an investment perspective or trading perspective, because if my stop-out level is 300 points down below current levels and my target is about 400 points above current levels, you're looking at almost a one-to-one risk-reward, and that's not good. So yes, I'm still bullish, but doesn't mean we're going to go immediately to 2200, although that's my target. There's always a price that says we're wrong, and my upside target will be 2200 unless the market closes under 1500. And just to give you a heads up, check out your email. In the next day or two, we're going to be announcing a first-time ever event, Conquering the 3 Biggest Trading Challenges, and we'll be showing you specific ways of knowing when to buy, when to sell, and how to find a watch list of markets that give the best trading or investment opportunities. So check your email on the next day or two. I think we have something scheduled for Wednesday, so you'll be the very first to be alerted. Okay, thank you for joining me.